These are 5 of the best Vanguard Growth ETFs to add to your portfolio in 2023. If you are looking for high growth potential ETFs as your main investment objective, these could be the funds for you. All the funds mentioned in this video are going to lean towards the investment strategy of capital growth. Growth-focused funds tend to have higher potential returns but face more volatility in share price and lower dividends as a trade-off. A good rule of thumb is that the younger you are, the more risky and therefore more growth-focused you can be as an investor. Number 5 is VOT, the Vanguard Mid-Cap Growth ETF. VOT seeks to track the performance of the CRSP US Mid-Cap Growth Index, which measures the investment return of mid-capitalization growth stocks. VOT currently holds 166 stocks in the fund, with top 10 holdings including companies like Motorola Solutions, Devon Energy, and Realty Income. VOT has an average annual return of 11.15% over the past 10 years and an expense ratio of 7 basis points or 0.07%, meaning you would pay $7 on every $10,000 invested. This fund invests in medium-sized U.S. companies with the investment composition focus on growth, since medium-sized businesses have more potential to further grow their market capitalizations than large-cap businesses. About 64%, or almost 2/3 of all its investments, are in 4 sectors: consumer discretionary, healthcare, industrials, and technology. This level of concentration into just 4 sectors can provide asymmetric upside when these specific sectors do well, but is also riskier if these sectors underperform. Number 4 is VT, the Vanguard Total World Stock ETF. VT seeks to track the performance of the FTSE Global All Cap Index, which includes both developed and still developing markets. VT currently holds a staggering 9,473 stocks in the fund from companies across the world. VT has an average annual return of 8.52% over the past 10 years and an expense ratio of 7 basis points or 0.07%, meaning you would pay $7 on every $10,000 invested. This fund holds a massive variety of stocks from across the world. While the fund is heavily concentrated in North American stocks, which make up 62% of the fund, VT is a good fund to get exposure to international and emerging markets without committing too heavily. European stocks make up the next largest share of the fund at 16%, followed by the Pacific at 11% and emerging markets at 10.5%. If you want a fund with growth potential and international exposure while still being considered a less risky fund, VT is a fund you should look at. Number 3 is VGT, the Vanguard Information Technology ETF. VGT seeks to track the performance of the MSCI US Info Technology 2550 Index, which measures the investment returns of stocks in the information technology sector. VT currently holds 368 stocks in the fund, with top 10 holdings including companies like Apple, Microsoft, Nvidia, and Adobe. VGT has an average annual return of 18.67% over the past 10 years and an expense ratio of 10 basis points or 0.1%, meaning you would pay $10 on every $10,000 invested. This fund can attribute its massive annualized returns to the roaring success of the US technology sector over the past 2 decades. While staggering returns of almost 19% annually probably won't last forever, the technology sector remains a strong investment area with favorable economics and many of the world's most important companies. The fund is top-heavy, with 40% of the fund invested in just the top 2 holdings, Apple and Microsoft. Yet, this fund remains an attractive choice for anyone pursuing the tech sector as a primary investment strategy. Number 2 is VUG, the Vanguard Growth ETF. VUG seeks to track the performance of the CRSP US Large Cap Growth Index, which tracks growth opportunities within the largest US companies. VUG currently holds 253 stocks in the fund, with top 10 holdings including companies like Apple, Amazon, Home Depot, and MasterCard. VUG has an average annual return of 13.43% over the past 10 years and an expense ratio of 4 basis points or 0.04%, meaning you would pay just $4 on every $10,000 invested. This fund has very strong annual returns of 13.5% while maintaining a diverse set of holdings across many industries. Unlike the previous VGT fund, which heavily concentrated in technology companies, VUG is much more diversified and therefore less risky to invest in. This fund is an excellent choice for investors seeking growth opportunities within the largest US companies without injecting too much risk of sector concentration into their portfolios. Number 1 is VOOG, the Vanguard S&P 500 Growth ETF. VOOG seeks to track the S&P 500 Growth Index, which measures the growth side of the S&P 500, the largest companies in the US. VOOG currently holds 230 stocks in the fund, with top 10 holdings including companies like United Healthcare, Google, Visa, and Tesla. VOOG has an average annual return of 13.62% over the past 10 years, and an expense ratio of 10 basis points or 0.1%, meaning you would pay $10 on every $10,000 invested. This fund weights towards the growth-focused half of the legendary S&P 500 index, holding the companies with the most growth potential. VOOG plays in a similar field to VUG, chasing growth opportunities in the large-cap US companies. Both funds are great investments, but VOOG offers a slightly different flavor of investment within the same strategy of large-cap growth, being less concentrated in its top company holdings and more diversified in sectors outside of technology. If you found this video helpful, don't forget to hit the like button, and if you want to see more videos breaking down top ETFs for different strategies, be sure to subscribe so you can see those videos when they come out. Thanks for watching.